Most people think making money is about timing the market, finding the next big opportunity, or getting lucky. But what if I told you that wealth is actually built in silence, through boring decisions that compound over time? No flashy moves, no overnight success, just simple strategies repeated consistently. In this video, I'll break down how money really grows, why emotions cost investors more than bad investments, and how small actions today can turn into life-changing results in the future. Because when you understand the game, you stop chasing money and start letting it work for you. Most people believe money is made through one perfect decision, a lucky break, or a sudden opportunity that changes everything overnight. But that belief is one of the biggest illusions in personal finance. The truth is far less exciting and far more powerful. Wealth is built the same way a magician masters a trick, through repetition, discipline, and attention to detail that nobody notices. Consistency is the invisible force that separates those who talk about success from those who quietly achieve it. Anyone can make money once, but very few people can follow the same smart behavior again and again, especially when results are slow or unexciting. This is where most people fail, not because they lack intelligence, but because they lack patience. When you invest consistently, whether it is time, money, or effort, you remove emotion from the equation. You are no longer reacting to headlines, market noise, or fear. You're simply showing up, putting in the work, and letting time do what it does best. The market rewards people who stay longer, not those who move faster. This is why consistency beats luck every single time. Luck depends on external factors you cannot control, while consistency depends entirely on your behavior. Even small actions, repeated over years, grow into something meaningful. A small investment made regularly can outperform a large investment made once and forgotten. Consistency also protects you from your own worst enemy, yourself. Emotional decisions are expensive. People buy when they feel confident and sell when they feel scared, which is the exact opposite of what works. A consistent strategy removes that temptation. You invest when things look good and when they look bad. You stick to your plan even when motivation disappears. Over time, this discipline compounds into confidence, clarity, and results. It is not dramatic, but it is effective. Think about how habits work in real life. One healthy meal does not change your body, but eating well consistently does. One workout does not make you strong, but showing up every week does. Money works the same way. Consistent saving, consistent investing, consistent learning. These actions are boring, predictable, and often ignored, which is exactly why they work. Most people are chasing excitement, while consistent people are building systems. Another reason consistency feels so powerful is because it aligns with how compounding works. Compounding does not reward intensity. It rewards time. The longer you stay in the game, the more momentum you build. Early on, progress feels invisible. Nothing seems to happen, which causes many people to quit. But under the surface, the foundation is forming. Eventually, growth accelerates, and suddenly it looks like success came out of nowhere. In reality, it was quietly building the entire time. Consistency also builds trust with yourself. Every time you follow through, you reinforce the belief that you can rely on your own decisions. This confidence spills into other areas of life, creating momentum beyond money. When people see success, they often underestimate the years of repetition behind it. They see the result, not the routine. The real secret is not what you do once, but what you are willing to do repeatedly when nobody is watching. Most people are drawn to quick gains because they feel exciting, immediate, and emotionally rewarding. A sudden spike in price, a viral investment tip, or a story about someone getting rich overnight triggers the same part of the brain that loves instant gratification. But this attraction is exactly what makes quick gains so dangerous. They create the illusion of progress without building a foundation. Compound growth, on the other hand, feels slow, almost boring, especially in the beginning. There is no dramatic moment, no rush of excitement, just steady progress that is easy to ignore. Yet over time, this quiet approach consistently outperforms short-term wins, because it works with human psychology and mathematical reality rather than against it. Compound growth works because it allows your results to build on themselves. Each small gain becomes part of the base for the next one. This means your money, effort, or knowledge is not just growing, it is accelerating. At first, the progress looks insignificant. The numbers barely move, and it feels like nothing is happening. This is the stage where most people give up and look for something faster. They do not realize that compounding is not linear, it is exponential. The biggest growth happens later, but only if you stay long enough to experience it. People who chase quick gains often reset their progress back to zero because they jump from one opportunity to another, never allowing momentum to build. Another reason compound growth beats quick gains is that it reduces risk. Quick gains usually require perfect timing and high exposure to uncertainty. You have to be right at the exact right moment, and if you are wrong, the losses can be severe. Compound growth does not rely on precision. It relies on time and consistency. By spreading investments over long periods and focusing on sustainable growth, you reduce the impact of bad timing and market volatility. This approach does not eliminate risk, but it manages it in a way that allows you to survive long enough to succeed. Compound growth also encourages better behavior. When people focus on quick wins, they become impatient, emotional, and reactive. Every small loss feels like failure, and every gain feels like proof that they should take more risk. This emotional roller coaster leads to poor decisions. A compounding mindset shifts the focus from short-term outcomes to long-term systems. Instead of asking how much you made today, you ask whether you followed your plan. This change in perspective creates discipline, and discipline is what turns average strategies into powerful ones. Time is the most underrated factor in success, and compound growth is how time becomes an advantage instead of an enemy. The longer you stay invested, the less important individual outcomes become. One bad year does not matter when you are thinking in decades. One missed opportunity does not matter when you are building something sustainable. Quick gains feel rewarding now, but they often lead to stress, regret, and inconsistency. Compound growth feels unrewarding at first, but it creates freedom, stability, and confidence later. What makes compound growth truly powerful is that it does not require perfection. You do not need to predict the future or beat everyone else. You just need to stay in the game longer than most people are willing to. While others are constantly restarting, chasing the next big thing, consistent compounding quietly continues. Over time, the gap between the two approaches becomes impossible to ignore. The results speak for themselves, not through sudden success, but through steady, undeniable progress. Have you ever made a big financial mistake? If so, you're not alone. One of the most common and costly mistakes people make with their money is investing in things they don't truly understand. It's a trap, and it's surprisingly easy to fall into. Maybe it starts with a hot tip from a friend, or a headline that promises unbelievable returns. Suddenly, you're looking at an opportunity that sounds incredibly smart, complex, and impressive. It makes you feel like you're in on a secret, giving you this false sense of confidence. But here's the hard truth. Complexity doesn't equal intelligence, and sophistication is no guarantee of safety. When you put your money into something you can't explain, you're not actually investing. You're gambling. You're guessing. Sure, a lucky guess might pay off once or twice, but it's not a sustainable strategy for building long-term wealth. True financial control comes from understanding. When you know what you're investing in, you can make decisions based on logic and reason, not just emotion. Think about it. When the market inevitably takes a downturn, and it always does at some point, what keeps you grounded? It's your knowledge. If you understand why you invested in a particular asset, how it actually works, and what its long-term potential is, you're so much less likely to panic and sell at the worst possible time. Who are the first people to sell when the market gets shaky? It's the ones who don't understand their investments. Fear rushes in to fill the gap where knowledge should be. They see red on the screen, and their only instinct is to get out, often locking in a loss. The market might not punish ignorance right away, but over time, it always exposes it. This is why simple investments are so often underestimated. They just don't seem exciting. A broad market index fund, a stable company with predictable cash flow, or a basic long-term savings plan. These things don't make for thrilling dinner party conversations, but don't mistake boring for ineffective. Simplicity is incredibly powerful because it's repeatable and resilient. The more complex an investment is, the more moving parts it has, and the more ways it can break. Simple strategies survive the test of time, not because they're perfect, but because they are understandable. When you can clearly explain your investment, you can track it, you can evaluate it, and most importantly, You can stick with it even when things get tough. Another huge benefit of investing in what you understand is that it builds conviction. Now, conviction isn't blind faith. It's informed confidence. It's the kind of confidence that comes from doing your homework, from knowing the potential risks, just as well as you know the potential rewards. When you truly understand both sides of the coin, you stop reacting to every little piece of short-term market noise. You're no longer swayed by every analyst's prediction, every breaking news, headline, or every daily price swing. Instead, you can calmly focus on the fundamentals that mattered when you first made the investment. This calm, steady approach is what separates successful long-term investors from emotional traders who are constantly chasing their tails and second-guessing every move. Understanding your investments also acts as a powerful shield against manipulation. Let's be honest, many financial products are intentionally designed to sound complicated. Why? Because that complexity can hide high fees, unforeseen risks, and even poor underlying performance. When you don't understand the mechanics of an investment, you also don't understand how it makes money or, more importantly, who benefits the most from it. And often, it's not you. The investor. By sticking to clear, understandable investments, you protect yourself from those unnecessary fees, hidden dangers, and unrealistic promises. You don't need access to some exclusive, secret opportunity to build wealth. What you really need is clarity. There's also a deeply personal side to all of this. Your financial journey is unique. Your goals, your timeline, and your comfort level with risk are all different from anyone else's. What works perfectly for a friend or a financial guru on the internet might be completely wrong for you. When you understand your own investments, you can tailor them to fit your life, not the other way around. You can align your portfolio with your personal goals. This alignment is a game changer. It dramatically reduces stress and boosts your consistency because you stop comparing your results to everyone else's. You're not on their path. You're on your own, running your own race. So, in the end, what's the goal of investing? It's not about proving how smart you are by picking the most complex thing you can find. It's about making sound decisions that you can live with, comfortably, for a very long time. The most successful investors aren't the ones who chase complexity. They're the ones who master simplicity. They consistently choose clarity over hype, understanding over excitement, and patience over urgency. By committing to only invest in what you truly understand, even if it seems almost too simple, you re-giving yourself the single greatest advantage an investor can have: the ability to stay in the game and remain invested when it matters most. Thanks for watching, and if you found this helpful, be sure to like and subscribe for more. One of the biggest hidden costs in investing is not fees, taxes, or market downturns, but emotional decision-making. Emotions feel natural and justified in the moment, yet they quietly sabotage long-term results. Fear and greed push people to act at the worst possible times. When prices are rising and everyone feels confident, people rush in, convinced they are about to miss out. When prices fall and uncertainty takes over, they panic and sell, believing they are protecting themselves. This cycle repeats over and over, and the market rewards those who resist it, not those who follow it. Patience is what breaks this cycle. Patient investors understand that markets move in waves, not straight lines. Short-term volatility is not a signal to act. It is a normal part of the process. When you accept this, you stop treating every price movement as a message. Instead of reacting, you observe. This mental shift creates space between emotion and action, which is where good decisions are made. Patience does not mean doing nothing forever. It means acting with intention rather than impulse. Emotional decisions are especially dangerous because they feel urgent. The brain is wired to avoid pain more than it seeks gain. So, losses feel heavier than gains feel good. This leads to overreacting during downturns. A temporary decline feels like permanent failure, even when the underlying fundamentals have not changed. Patient investors look beyond the immediate discomfort and focus on the bigger picture. They understand that short-term pain is often the price of long-term progress. Another reason patience is rewarded is that it allows strategies to play out fully. Most investment approaches fail, not because they are flawed, but because they are abandoned too early. People change plans constantly, moving from one idea to another, hoping to find something that feels easier or faster. Each change resets progress and increases the chance of mistakes. Patience gives a strategy time to prove itself. It turns consistency into an advantage rather than a challenge. Avoiding emotional decisions also improves clarity. When emotions are high, thinking becomes narrow. You focus on what is happening now and ignore long-term consequences. By staying patient, you maintain perspective. You can evaluate information calmly, adjust when necessary, and avoid extreme reactions. This clarity is what separates disciplined investors from reactive ones. They are not immune to emotion, but they do not let emotion dictate their actions. Patience also builds confidence over time. Each time you resist the urge to act emotionally, you reinforce trust in your process. This trust reduces stress and second-guessing. You stop checking prices constantly and stop measuring success in days or weeks. Instead, you measure progress in years. This long-term mindset creates a healthier relationship with money and investing. The market is designed to test emotions. Headlines exaggerate fear and excitement because attention is profitable. Those who react to every headline become part of the noise. Those who remain patient quietly benefit from the chaos. They understand that doing less, not more, is often the smartest move. By avoiding emotional decisions and embracing patience, you align yourself with how wealth is actually built. Slowly, steadily, and with intention. Many people delay starting because they believe their efforts will not matter unless they can begin with something significant. They wait for more money, more time, more confidence, or the perfect conditions. This waiting feels logical, but it quietly works against them. Starting early, even with small amounts, creates an advantage that cannot be replicated later. Time is the one factor in growth that cannot be rushed or replaced. When you start early, you give your actions room to compound, evolve, and mature. The size of the starting point matters far less than the length of time you stay committed. Small beginnings are powerful because they lower the barrier to action. When something feels manageable, you are more likely to do it consistently. A small investment, a small habit, or a small learning commitment does not feel intimidating. It fits naturally into your life. Over time, these small actions become part of your identity rather than a forced effort. Consistency grows naturally when the starting point is realistic. Waiting for the perfect moment often leads to inaction, while starting small creates momentum. Starting early also teaches valuable lessons with low risk. When the amounts are small, mistakes are affordable. You can learn how markets behave, how emotions affect decisions, and how systems work without risking everything. These early experiences are incredibly valuable because they build understanding and confidence. People who start late often feel pressure to make big moves quickly, which increases stress and the likelihood of emotional decisions. Those who start early grow alongside their investments, learning as they go. Another overlooked benefit of starting early is psychological. When you begin, no matter how small, you shift from thinking about doing something to actually doing it. This change in mindset is powerful. You stop seeing wealth building as a distant idea and start seeing it as an active process. Progress becomes visible, even if it is slow. This visibility reinforces motivation. You are no longer standing on the sidelines wondering when to start. You are already in motion. Time magnifies small actions in ways that are difficult to appreciate at first. Early progress feels almost invisible, which is why many people underestimate it. The numbers move slowly, and the results do not seem impressive. But compounding does not reveal its strength early on. It builds quietly. Each small contribution adds to the base, and over time, that base becomes significant. What looks insignificant in the beginning becomes powerful simply because it had more time to grow. Starting early also reduces pressure later in life. When you give yourself time, you do not need to rely on extreme strategies or unrealistic expectations. You can afford to be patient, balanced, and flexible. Small, steady actions, taken early, create options later. They give you freedom to adjust, pause, or change direction without panic. Waiting until later often forces urgency, which leads to stress and risky decisions. There is also a mindset shift that comes with starting small. You stop measuring success by dramatic results and start valuing progress. This perspective makes it easier to stay consistent. You understand that growth is not about sudden breakthroughs, but about showing up repeatedly. Each small step reinforces the habit, and habits are what drive long-term outcomes. The idea that small beginnings are pointless is one of the most damaging myths in personal growth. In reality, small beginnings are often the most sustainable. They allow you to build systems instead of relying on motivation. They turn time into an ally rather than an enemy. By starting early, even with modest effort, you give yourself the most valuable advantage of all, the chance to let time work on your behalf, while others are still waiting for the right moment. Everything you have heard comes down to a simple truth that most people overlook. Wealth is not built through dramatic moments or perfect timing, but through calm decisions repeated over time. Consistency beats luck. Patience outperforms emotion, and understanding protects you from costly mistakes. Small actions, when started early and maintained with discipline, grow into results that feel almost magical from the outside. The people who succeed are not smarter or luckier. They are simply willing to stay committed when progress feels slow and invisible. When you stop chasing excitement and start trusting simple systems, money stops being a source of stress and becomes a tool that quietly works for you over time.